Hi everyone, in this masterclass we are going to take a look at candlestick patterns. So in the masterclass what we're going to cover, we're going to take a look at candlestick charts, what are they? And we're going to look at the most common candlestick patterns. So these are what the candlestick charts look like. So we're having here slightly different to the normal open, high, low, close. You can see in here the open, low, close and high. This one bullish. Bullish is when the close is higher than the open. And you can see in here often coloured in white, sometimes coloured in green, sometimes left clear. Or we have the black candlestick in here, often sometimes in many charting platforms we see this in red when the open in here is higher than the close. So the market moving down through the session, and the extremes are marking here the highs and lows. But let's take a look at a little bit more and talk a little bit more about the construction of these candlestick charts. The candlestick chart similar to the bar chart. That's the open, high, low, close chart. It differs in the way it's visually constructed, as we just saw. The candlestick chart has a wide bar on the vertical line, which illustrates the difference between the open and the close. That bar that we looked at that was coloured in, that's the difference between the open and the close. This is called the body, or the real body of the candlestick. If the close is lower than the open, the body is shaded in. It's often black or red. If the close is higher than the open, the body is usually then clear or white or green. The thin lines above and below the real body are called the shadows, also called the candlestick wicks. The peak of the upper shadow is the high of the period, and the bottom of the lower shadow is the low of the period. And here we have the ANZ daily chart, the ANZ Bank daily chart, and we see in here a candlestick chart. Here we see them in red and green, red being the up candlesticks, the bullish candlesticks, and green being the bullish candlesticks, and red being the bearish candlesticks. So let's have a look at some of the most commonly used candlestick patterns now. A candlestick pattern whereby the body of a bearish candlestick engulfs the body of the previous candlestick. This is called a bearish engulfing pattern. A candlestick pattern whereby the body of the candlestick engulfs the body of the previous candlestick. And here we see an example here in our graphic in here. So we see the body in here, the body, that's the darkened area, engulfing the body here of the previous candlestick. And here on the daily ANZ Bank chart in here, we see in here a bearish engulfing candlestick here. And you can see it's a turning point, an underlying uptrend, and then the market reversing lower. Same here, underlying uptrend, the market reversing lower, signaled by this bearish engulfing candlestick. The bullish engulfing candlestick is just the opposite of that. The bullish engulfing pattern, a candlestick pattern whereby the body of a white candlestick, a bullish candlestick, engulfs the body of the previous candlestick. This is usually seen in here. So in the bullish engulfing candlestick in here, we have the daily NZ Bank chart in here, the market moving lower, and we have in here the market, the bullish engulfing candlestick in here. We can see engulfing the previous candlestick and then signaling a turning point and a more bullish tone. A hammer pattern next. We're going to take a look at a hammer pattern. A bullish candlestick pattern usually seen at the end of a bear trend. So it's a turning point for a bear trend. The market trades considerably lower than its open, but rebounds to close above or near the opening price. Then the subsequent candlestick needs to see a break above the high of the hammer candlestick to confirm the reversal. Much easier to take a look at it. So here's on the graphic is the hammer pattern. The market opens lower, is in a downtrend, opens lower, and then we see a spike lower and then a rebound during the day. So the market closes back near to the opening price. We get a close near the opening price and then subsequently moves higher in here above the candlestick high from the hammer pattern to then confirm the candlestick pattern, to confirm the reversal. Here on the daily ANZ Bank chart, we see the market dipping lower initially, get a sell-off here, then we get the rebound. This is the hammer pattern, and as the market breaks higher, it signals then the conclusion to the downtrend. Not into an aggressive bull trend, but nevertheless signaling the conclusion of this downtrend. Let's now take a look at the inverted hammer pattern. This is a bullish candlestick pattern, usually seen at the end of a bear trend. Formed from a significant rebound after the open, then a sell-off near to the opening level, but then the subsequent candlestick then needs to break above the high of the inverted hammer candlestick to confirm a reversal. So what does that look like? So the market's in the downtrend. The market then tries to rebound and then fouls back lower. Now this does not become then bullish until we actually see this candlestick here, till the market breaks back higher above the high. Okay, so this is the inverted candlestick, but the confirmation then comes when the market moves above the high here. So here again on the daily ANZ Bank chart, the market's in a bear trend. We get the inverted hammer pattern down here, and then it's only confirmed when the next day we move higher, and then that signals a conclusion of this downtrend. The hanging man candlestick pattern, again a bearish candlestick, or here, sorry, a bearish candlestick, usually seen at the end of a bull trend, formed from a significant sell-off from after the open, but then a rebound near to the opening levels, and then the subsequent candlestick needs to break below the low of the hanging man. So let's take a look at that. So we're in an uptrend, the market dips lower and then rebounds, but then it's subsequently, when it moves lower here on the next candlestick, that is when the hanging man is confirmed, and that's when we get the reversal signal. So here the market's in an uptrend. Here's the hanging man pattern. It's not till here, it's not till this candlestick, 3 candlesticks later, 1, 2, 3, the market breaks below the low of the hanging man pattern, and then that signals that this uptrend is reversed and we're now in a slightly more negative theme. A shooting star pattern similar to the last pattern there, a bearish candlestick pattern usually seen at the end of a bull trend, formed from a significant rally after the open, but then a sell-off near to the opening levels, and then the subsequent candlestick needs to break below the low of the shooting star candlestick. So here we have an uptrend, the market pushing higher and then fading back lower in here, and then subsequently as we break below the low of the shooting star, it signals a more bearish tone. Here we have the market moving higher, we have a shooting star pattern, the market moves higher and then back lower, breaks lower, and then it signals a more bearish theme. So we're in a mini little corrective uptrend in here, and the shooting star signaling the conclusion to that mini uptrend. So in today's masterclass, we've taken a look at candlestick patterns, what they are, and what are the most common candlestick patterns in use. This has been Steve Miley for The Bull, and please do join us again on thebull.com.au and thebull.asia. Stay bullish.